by our Dean and Director, Dr. Fuld. I have the honor and pleasure of inviting him to the podium. Sir.
Assalamu alaikum, everybody. This afternoon I have the pleasure of introducing not only somebody who's established himself in the last 30 years as one of Pakistan's best known, I suppose, international financiers involved in the world of international finance, but also somebody who went to high school with me. Sadeq Sayeed, Sadeq and I were together in high school in Karachi, spent years here. Then we were together in Boston in the United States for several years. So we have known each other for a while, but then of course we ended up doing different things. And we were both connected with the world of international finance. I was with the World Bank, very different type of international finance, and Sadeq was in the area of international commercial finance, where he established a name for himself, in particular in the times surrounding the great financial crisis of 2008, 2009, when he was associated with Nomura, and he went on to become actually a president of Nomura International. Worked with them for several years before becoming an independent financial advisor, I suppose is the right word. He currently operates as the chairman of Metage Capital, which is an independent financial advisory company. And but I really want to sort of go back to the time when Sadeq was in Boston with me, which is when he first got interested in the area of finance. Before that, he was an engineering-oriented person. He has an MIT engineering degree. But then at some point, he decided that was not what he wanted to do. And he went on to the Sloan School of Finance. And after that, he never looked back on engineering at all, unless I guess it was in the construction of derivative products in finance, which required some of the same formulas as engineering did. So he started with finance there, and he has kept on in that area. So I think today we have the privilege of listening to someone who's not only had a very good background in finance theory, sort of the academic side of finance, but has then been practicing it for the last 30 years in a very successful fashion. And in particular, he was tested, I think, in the bear market of 2008, 2009, which is usually when you can tell, as they say, the men from the boys. Anyhow, I would like to hear Sadeq speak on some of those matters if he has the time. But otherwise, of course, his general subject for today is decision-making in financial markets. So let me invite Sadeq to the podium. Thank you. Okay.
Well, thank you very much. That was one of the nicest introductions I've ever had. So you can pat yourself on the back for that. Farooq was at Harvard when I was at MIT, and he was into economics when I was into engineering. And the 2008 crisis that he refers to, the one thing I did in that crisis, I guess it was a capping moment in my career, was to acquire Lehman Brothers. How many of you have heard of Lehman Brothers? Okay, so Lehman Brothers went bankrupt on the 15th of September 2008. And by December 19th of 2008, I had acquired all of their assets, businesses, etc. in Europe, Middle East, Asia, Tokyo, everything. The stuff I left out was the United States. And I will explain to you how and why that happened, and it was a lot of fun. It was so much fun that about 3 years later, I was drained out and I retired, or semi-retired. And I spend my time now doing a little bit of work with Silk Bank in which I'm an investor. I did Silk Bank as an investment at about the same time as I bought Lehman Brothers for Nomura. And there are no prizes for guessing which the better trade was. Nevertheless, the bank survives, and we are continuing to work on ensuring that this bank also will be a successful feature of the Pakistani banking system over the next several years. What I would like to suggest for all the people sitting back there is if you wouldn't mind just coming forward so I can point to you and embarrass you as much as possible. आप लोग आगे आ जाएं और ज़रा ये जगहें भर लें तो it'll be easier. Thank you very much. Okay. Usually when I give a talk, I have a set of slides. There are about 24 of them. But I pick and choose which of those I will talk about on any given day. And I let the audience choose what they want to hear. But today I'm not going to let you do that. I'm going to choose what I want to talk about because this is a subject of deep interest to me. And it's about, the title is Decision Making in Financial Markets, but it really is about decision making under uncertainty. And I'd like to ask one quick question before I launch into this thing. How many of you have heard of or understand options in the financial markets? Just a raising of hands. Okay, so some people. All right. That makes it just a little bit difficult. But what I'm going to do is to try and give you a crash course in option pricing. Not the mathematics of it, which can get, as Farooq said, quite complex from an engineering perspective. But I will give you the intuition behind option pricing. And then what we will do subsequent to that is we will do a thought experiment, which takes how you price options and what parameters you use to price options and stretch your imagination a little bit into other aspects of decision making in the financial markets. So be prepared, please, to do two things. One, think through things with me. It may not be as easy as some of you might like, so I'm going to force you to pay a little bit of attention on a couple of things. And then also bear with me, because a lot of what I say and what I speak of as Sayeed truth is not necessarily that. It is conjecture with a fairly significant amount of casual empirical evidence that supports that conjecture. But it is not a PhD thesis which has been written and proven without any doubt. But it's fun, and I think you might well enjoy it. It leads to all sorts of interesting conclusions as to why certain things happened in the financial markets. So I'll start with this very, very simple graph. How many of you have seen this kind of a graph before? This is a standard option valuation graph for a call option. So a call option is a right but not the obligation to buy anything. It doesn't have to be stock. To buy anything at a fixed price at a given time in the future. You have the right but not the obligation. Call options have not existed only for the last 20 years. Call options have existed for the last 200 years. The agricultural markets of the United Kingdom and Europe depended on call options to provide liquidity and hedging for the people who produced things, from wheat to meat. And here's the funny thing. When Merton did Bob Merton is a very well-known Nobel Prize-winning finance theorist and a very close friend of mine. In fact, in some respects, a mentor. When he did some analysis historically, he found, shock horror, that the data showed that the options were priced even in those times that the Black-Scholes model, which is a model which is used to price options, I don't have to go into it in too much detail, didn't exist. Options were priced pretty close to what they should have been priced at. That's shocking. 200 years. And they were close. Why? Because at the end of the day, markets work. A lot of people don't believe in it, but they do work. They don't work perfectly, but they work pretty darn well. This picture is important only in the following sense. I'm going to distill from the valuation of a call option everything except for one aspect of it, which is implied volatility. How many people over here understand the word volatility? What I mean by it? सबको समझ में आता है? Market ऊपर नीचे जाती है, जितनी तेजी से जाती है, जितने time में ऊपर नीचे जाती है, उसको volatility कहते हैं. And the more it bounces around, the bigger the amplitude of volatility, the more important it is for options. And I'll try and explain why. Suppose you've got the right but not the obligation to buy a piece of stock at 100 1 year from today, and the stock is trading at 100 today. If the stock moves around very, very little, let's call it doesn't move at all, ठुस बैठा हुआ है 100 पे. What is the value of the option to buy the stock at 100 1 year from today? Is there any value to that option? Sorry? Zero. In fact, it's absolutely zero, because 1 year from today, if you discount 100 back till today, it's cheaper. So there's no value to that. Now let's introduce a little bit of bounciness in the stock. Let's assume it goes up or down by 5% within 1 year, one time. It either bounces up 5% or bounces down 5%. So all it does, it's a simple model. Now, is the option worth something? Of course it is. Is it worth something if the stock bounces down by 5%? Absolutely not. But have you lost anything? You've lost nothing other than what you paid for the option up front. Correct? And you're not going to pay 5 for it, because there's only a half probability that it'll go up by 5. Correct? But it's worth 5 if it goes up by 5. So you're willing to pay something for that option today, and simplifying it, you're probably going to pay, if it's an equal probability up and down, you're probably going to pay about 2.5 for that. Forget about interest rates, forget about discount rates, forget about everything else. ठीक है, समझ गए? And the more it bounces up or down, the happier you are, the more you're happy to pay for it. So volatility is your friend. समझ गए? So here's my first hint at where we're going to go with this discussion. When you own call options, you love the underlying asset to be bouncy in price. And the bouncier, the better. Is that clear to everybody? If somebody has a question, please ask now, because I'm going to stretch this a little bit. Okay, let's take it from there. So what these 3 lines show is, or curves show, is if the stock is not very volatile, 10%, you've got the green line. If it's volatile by 20%, you've got the purple line, and 30%, you've got the light blue line. Essentially, it means that the value of the option monotonically increases with volatility. Very, very simple. Okay, I'm not going to talk about put options, I'm not going to talk about Black-Scholes, I'm just going to talk about this one little aspect. So what I want to start with, now that this is clear and all of you are call option at least pricing experts, I'm going to give you a trade example. I'm going to give you an example of an actual portfolio transaction that I conducted when I was at Credit Suisse First Boston as a fledgling trader in 1986. It's a long time ago. Half of you probably weren't born then, but I was in the UK markets and I was asked to join something called the arbitrage desk. And very, very much around that time, the Japanese had started to issue what are called Japanese equity warrants. I'm sure most of you don't even know what those are, but I'll explain to you what an equity warrant is. An equity warrant is simply a call option. The difference is that I can issue a call option to Adnan over there, no problem, and we can have a bilateral contract. But a warrant is issued by the company whose shares that warrant is written on. Okay? So it's issued by the company. By and large, warrants are pretty long dated, 5 years. And by and large, they have strike prices, which is a price at which you have the right but not the obligation to buy the stock. at about where the stock price is trading at that time. And the Japanese in 1985 onwards and 86 onwards started to issue just swaths of these warrants. Why did they issue these warrants? They issued them because for the warrants, people in the market were willing to pay something. As we just determined, a warrant is worth something if the underlying stock is bouncy. So people in the market were willing to pay something. They took that money, and then they assumed that that money was free money. Because if that warrant got exercised, they just issued new shares. Now we know that an accountant might think that's free money, but the markets know it's not. Nevertheless, they issued these shares. Ab main dekh raha hu in cheezon ko. And thousands, millions of these warrants were issued on about 20 companies in Japan. About 20 companies issued these warrants. So what they would do is they would issue these warrants together with bonds. Ab 10 साल का बॉन्ड डाला, उसके साथ एक 5 साल का वारंट लगा दिया. वारंट के लिए अगर इनको 100 रुपए का बॉन्ड था, 5 रुपए का वारंट मिल गया, they thought they issued the bond for 105, and therefore the financing cost dropped. We looked at the warrant and said, my God, at $5, that's very, very cheap. We knew it was cheap. So we wanted to buy it. So we started to buy these warrants. Here's the interesting thing. What happens when you buy a warrant? Remember I told you I was hired into something called the arbitrage desk. When we bought warrants, we didn't just sit there and say, tomorrow the stock on which this warrant is written is going to go up or down. We didn't say that. What we said was this warrant is cheap. How did we extract the cheapness? We would hedge the warrant against the stock. Now let me explain to you how you would do that. If you buy a warrant or a call option for 1 year, and I told you the call option is worth about 2.5 rupees or dollars or 2.5%, if the volatility is plus or minus 5%, you can imagine right away what that is like. It's like owning, instead of 100 units of that share, 50, right? Because if it goes up by 5, how much do I make? 2.5. So it's very much like owning half the number of shares. And that's called a delta hedge. And the delta there is 0.5. So हम जब इसको hedge करते थे, for every warrant we bought, we did our analytics, we did our models, and we figured out what our delta hedge was. And the delta hedge required us to sell that much of the stock against the warrant in order to be flat. At that point, if the stock went up or down, the warrant also went up or down in exactly the same amount, and we didn't make any money or lose any money. And if we kept doing that over a period of time, we would extract the extra value out of the warrant. But now, this is the insight that I think got me trading this in a slightly different way, slightly out of the box, as they say. Let me ask you a question. Suppose you've got this warrant and you're hedging it against the stock. If you buy a call option and you sell a unit of stock against it or half a unit of stock against it, you're flat. So for every position you buy in a call option, you're long stock. Does everybody understand what I mean by being long stock? That means that if the stock price goes up or down, I benefit when it goes up and I lose when it goes down. So I have to hedge it with a position that benefits me the opposite way. And that I do by selling the option. And every time the stock goes up, it goes what we call deeper in the money, and the mathematics tells me I need to sell a little bit more stock. So the more volatile the stock is, the more I have to trade, and the more up it goes, the more stock I have to sell. The more down it goes, the more stock I have to buy. Is that clear? That is what the delta hedging routine does. Not everybody got the following problem. The problem was this, that every time you sold stock when it went up, what did you do to the volatility of the stock? You attenuated it. And every time the stock goes down, you're buying it. If you were a large enough player in the market, what did you do to the price of the volatility of the stock? you attenuated it. So if you bought a very large number of these options on an individual share, and you delta hedged them religiously and analytically properly, you endogenously attenuated what made the position that you owned strong. So you killed yourself. You were committing suicide by buying a warrant and being financially pure by hedging it with the underlying stock, because the correlation between the warrant and the underlying stock is perfect, right? It's on the stock. It's perfect. So you hedge it with the underlying stock. I realized that this is going to be a problem. And I called it at that time in 1986 the problem of endogeneity. Because everybody in the option pricing world assumed that the volatility of the stock, i.e. how bouncy it was independent of everything else. It was an exogenous factor determined by macroeconomic conditions and other players in the market and financial crises. And you asked for it. It was independent. But it wasn't. It depended if you were a large enough player on what option traders, derivatives traders, were doing with their positions in the warrants. Has everybody got that? समझ गए? अगर किसी को ये समझ में नहीं आया मैं आगे नहीं जा सकता. Who doesn't get this? Please, question. नहीं बोलिए. Please don't be ashamed. I won't kill you. I might make you feel embarrassed, but I won't kill you, I promise. बोलिए.
मुझे समझ में नहीं आया कि kindly repeat the concept of volatility.
Okay. Volatility is how bouncy the stock is.
Yes.
Okay.
But how it impact? Or you said it if it is like suicide. I didn't.
I'll try and explain. I'll explain that. So, assume the stock price. Forget about the warrant for a minute. Let's assume the stock goes up by 10. And you, being a big time trader, see that it's gone up by 10. And now what you do is you say, I've made some money. From 100 it's gone up to 110. I'm going to sell. ठीक है? I'm going to sell my position. When you do that, what's going to happen to the price of the stock? नीचे जाएगी ना? Okay. So it'll go down to 109. If you need to sell some more, you'll sell some more. What will happen? It'll go down to 108. When it goes to 108, your hedging routine is going to tell you sell some more. What are you going to do? It's going to set you sell. The market will go down some more. Now, think about the stock going down by 10. Now, if you try to buy it, what will you do to the stock price? You pop it up a bit. And if you follow that logic, what will happen is that the bounciness of the stock will go down. It'll be compressed. And if it is compressed, the value of the option that you own, that you're long of, will go down. That is what I mean by suicide. Because the option that you own itself goes down in value when volatility goes down. And you, by your own actions, are making the volatility go down. Okay? That is this idea of endogeneity is very important for the rest of the talk I'm going to give you. I want to tell you how we got around this problem. I mean, we did trade those warrants for several years and we made a lot of money. So we went back and we took a look at the Japanese stock exchange and we took a look at the futures market and the individual stock markets to try and see how much volume we could trade in those markets. And we noticed that the cash and the futures market, the cash market is a red, so in percentages it's the shaded area, and in actual amounts it's the line. और लाल यहाँ पे clearly नज़र नहीं आ रहा, मगर line नज़र नहीं आ रही, मगर the red and the green lines told me essentially that the futures market was at least as liquid, if not more liquid than the cash market. So I could trade the futures market without disturbing the overall stock market. Remember that an individual stock will be quite illiquid, but the futures market and the stock market will be very liquid. Lots of people are trading it. So my small actions will not affect the price as much and will therefore not affect the volatility of the market very much because I'm a small player. And the next step I saw was the following. Again, an incredibly simplistic graph. This graph essentially takes a portfolio of 30 stocks. The Japanese, the Tokyo Stock Exchange Core 30. 30 stocks. And it tries to see how many of those stocks do I need to trade in order to replicate the entire 30. यानी 30 stocks का जो futures market ऊपर नीचे जाती है, can I trade just one stock and mimic it? Do I need to trade 2 stocks to mimic it, or do I need to trade all 30 stocks to mimic it? Does everybody get this concept of mimic? All right. So simple statistical large numbers shows you that about 20% gets you up to about a 95, 96% correlation, about 20% of the stock. Out of 30, 6 stocks will get you to a point where the rest of it is just an error. So you could trade 6 stocks and mimic the futures exchange. But what I realized was you could trade the futures exchange to mimic the 6 stocks. If one works for this one direction, it works for the other direction. And if you trade the futures exchange, you do not cause the attenuation of volatility in the individual stock that you traded. Right? Because the futures market is taking that volatility and it doesn't affect the individual stock. In fact, the market doesn't know that you're hedging your warrant out with that stock. So what we did was we built a portfolio of these stocks and then we traded the futures market against it. That way, the endogeneity problem was solved. And there is no free lunch in the financial markets. And what did we pay for solving the endogeneity problem? About a 5% tracking error. Because the futures market did not perfectly replicate the portfolio that we had. But the 5% tracking error was nothing in comparison to the loss we would experience if we attenuated volatility. So that was a trade in 1986. I'm not going to tell you that made my career, but it was a start, because it was a way of thinking that was not entirely the way everybody else thought. We took what we thought were good ideas and applied them slightly wider than most other people did. So that was the first thing. Now, a little corollary, a little story next to it. How many people have heard of LTCM? That will come up again later. Long-term capital management? Of course you do, Shuja. You were a big investor, weren't you? So long-term capital management in 1998 was the biggest arbitrage trader in the market. And this trader, this huge hedge fund, came to London and they opened a London office and they asked me about warrant trading. And they knew I'd been involved in the market. And they said, we are purer than you are. What we are going to do is we are going to trade the warrant against the underlying stock directly. We're not going to do all of this mumbo jumbo that you do, because we are pure finance guys. Guess who was right and who was wrong? $150 million loss later after a year. And as soon as I knew they were coming in and they were going to trade that, my entire warrant portfolio was exited. Immediately, got rid of it. It took me 3 days to get rid of the entire position, because I knew that they were going to be trading it that way and they're going to attenuate volatility. Unke liye bhi kharab, mere liye bhi kharab. So they didn't get endogeneity, and they were probably some of the smartest traders the market had ever seen. But long-term capital will show up later in my next application of this concept of endogeneity. So what we are now going to do is talk about endogeneity in compensation structures for banks and for other institutions, and how that leads to poor decision making in those institutions. Okay. First, I need everybody to understand what a stock is. A stock, a piece of equity that you buy in the market, you may not realize that, is simply a call option. I don't see puzzlement on everybody's faces, but it's simply a call option. It's a call option with a very, very long life, because the stock never goes, unless the company goes bankrupt, lives forever. And you might ask me, what is the strike price? What is the price at which I'm buying this company against which I have this option? The strike price is the debt of the firm. Agar aapne aakar stock kharida, what your right as a stockholder is to, but not the obligation, is to buy the company out entirely by paying off the debt. So a terminal example is the following. Suppose the company decides to shut down operations tomorrow. What happens is that the company sells off all of its assets, it pays off its debt, and whatever is left over as residual is what the stockholder gets. That's what the value of a stock is. It's not just the present value of dividends. That's the real terminal value of a piece of equity. The terminal value of the piece of equity is once you've paid off the debt, what is the residual value left within the company? And therefore, the call option is the piece of equity is simply a call option on the value of the company, with the strike price being all the debt. I'm not the one who invented this theory. It was a guy, Bob Merton, invented it. It was in a Bell Journal article of 1974. It was brilliant. But taking it from there to the next step is more interesting. So, I'm a banker. I worked at Credit Suisse for 15 years, or CSFB, and then I worked at Nomura for 11 years. Virtually all of my compensation for virtually the entire period that I worked at these two institutions was in call options on the stock of the underlying institutions. So to incentivize me and to make me behave in alignment with other shareholders, what the company policy was to give me shares and share options so that the way I behaved as a manager, as a senior manager of these institutions, would be aligned with the shareholders. All well and good. But for a bank, it's horrible. It is absolutely terrible. Let me try and explain why. Take any commercial bank. What distinguishes a commercial bank really from other financial institutions and from other corporate institutions? What distinguishes a commercial bank from other corporate institutions, less and less now, but at the time a lot, was that if the commercial bank goes pear-shaped, if it goes belly up, there is always going to be some kind of bailout. History has told us that every time the banking system goes a bit haywire, the entire political system and the banking system jumps to their rescue and they try to bail them out. It's happened all the way through time. And then regulations are changed in order to help the banking system not collapse. Because if the banking system collapses, the cost to the entire domestic and global economy can be quite enormous. So what the regulators do is they say, we can't allow that to happen. It would be absolutely disastrous, so we're going to bail them out whenever they get themselves into trouble. Now think about the consequences of that kind of a rule embedded within the financial system. It is a rule. It's like rules of chess. Chess tells you that when you play with a knight, the knight moves in rather a crooked fashion. But that's the way it is. You play that rule, your opponent plays in that rule. The same thing applied in the financial markets. Now think about this. I own, as a banker, a whole bunch of shares in my bank. Not just shares, I also own call options on those shares. Shares themselves are call options. I own a call option on top. Let's play a little game. And this is what I call the Dick Fuld game. Do you know who Dick Fuld was? Dick Fuld was the CEO of Lehman Brothers when Lehman Brothers went bankrupt in 2008. And the Dick Fuld game was this. I own call options, and I'm going to simplify his game a little bit. I own call options because that is what my net worth is. All of me and my managers, we have these call options. And if Lehman Brothers goes bankrupt, the Fed will be in to save us. Okay? Now, when Lehman Brothers is doing poorly in 2008, what is his incentive? Let's go back to endogeneity on the call option that I explained to you. What is his incentive? What is he going to do? He owns call options and he owns stock. We agreed that increased volatility increases the value of a call option. What's he going to do when he thinks things are not going very well? He's going to want the volatility of the underlying stock that he owns to go up, not down. How do you increase volatility? You take more risk. Why? Simple. Suppose that the stock is priced, Lehman Brothers stock is priced at 100. Just example. The debt that Lehman Brothers has is priced or valued at 80. At this point, enterprise of Lehman Brothers is priced at 100, and the debt that Lehman Brothers has is priced at 80. The value of the stock, doesn't take a genius, is 20. Clear to everybody? Okay, so now everybody is happy. The debt holders are happy, the stockholders are happy, the institutional investors are happy, and guess what? Even the regulator is happy. Now the market starts to go a bit wonky, and the stock price drops to 80. Enterprise value drops to 80, stock price drops close to 0. Happens in the markets, comes to 0. Now, think about it for a moment. What is my incentive as a manager who owns a ton of this stock? If I take some risk and the market goes up by 5, or the value of my company goes up by 5, who makes the money? The stock guy makes the money, correct? But if I take a risk and the market takes my enterprise value down by 5, who pays for it? Sorry? Not at all. The stockholders don't pay for it. Why would the stockholders pay for it? The bondholders pay for it. Because remember, the bonds are worth 80 and the stock is worth close to 0. I'm a manager. I'm not just a passive institutional investor. I'm taking some risk. And if the market goes up, my stock is now, if the market of the enterprise value goes up from 80 to 85, my stock is suddenly worth from 0 to 5. Meri to eid ho gayi. Market goes down by 5, the risk doesn't do well, I lose money, the institution is now worth 75. I was already at 0, I'm still at 0. Who's paying the 5? The debt holders. So this is again, it's both moral hazard and most importantly, it's endogeneity. Because I, as a stockholder, can affect the volatility of the value of my enterprise. So therefore, what is the most stupid way of compensating the banker? Is that way. It's through stock. Why did I talk about regulation in the banking system? Let me circle back now to what the real issue is here. The real issue is TK, bondholders, stockholders, they can negotiate amongst themselves, the market works, and the bondholders will always price this endogeneity in the stockholder, and therefore in a company which has a lot of stock given to the internal management, they will buy bonds much more cheaply at a much higher yield to compensate them for it in the market. So that can be made to work. Does everybody understand why that can be made to work? But here's what doesn't work. Is if the bank goes, let's assume now that this institution doesn't have debt. It just has equity, and the value of the equity is going down to close to 0. If I now take risk, and the market from 0 goes to -5 of this institution, who pays for it? There are no debt holders anymore. Who bails it out? They're the ones who are going to pay for it. Who bails it out? The Fed, the reserve system, the central bank, the Treasury. At the end of the day, they are simply agents. Who are they agents for? You and me. So the taxpayer bails them out, and the guy who's got the call option and the guy who is running risk in a banking system knows that he's got to get bailed out. And therefore, he has a strong incentive to take more risk the worse the institution performs. Now, some people may say that this is unethical. Well, it ain't unethical. What's ethical or unethical about it? That's the rules of the game. That is how a capitalist system works. That is what a stock is. And the actions taken by the central bank or by other regulators are not my problem. They're going to be doing this. And I'm just behaving in the way that I'm told, or I believe, from a rational expectations point of view, what is going to happen in the future. I'm just behaving in line with those rules. So let's go back to 2008 a little bit and see what happened. Before September 15th, 2008, September 15th, 2008 was a very, very interesting day. The week before, I was in Spain, sitting on a lovely terrace, beautiful sunshine, looking out over the water, trying to relax, and on the phone with people from Tokyo and with people from the Federal Reserve in New York, in particular Mr. Geithner. And what were we talking about? We were talking about Lehman Brothers, of course. And Lehman Brothers, Mr. Geithner, we were begging Mr. Geithner for financing to buy Lehman Brothers. And Mr. Geithner said to us, you must think I'm a complete idiot if you think that I'm going to lend you, a Japanese firm, domestic US dollars to buy a failing domestic US firm. You know what? He was absolutely right. But we were having it on. We were trying to see whether he would lend us money to buy it. He didn't. So we wrote it off. And on Sunday, I flew back to London. And I went to my house and I fell asleep. And I got up in the morning, on Monday morning. And at that time, we used to have Blackberries. Up to iPhones, they don't flash very much, but my red light on my BlackBerry was flashing at 6 a.m., which is when I normally woke up. And I picked it up, sitting next to my bed, opened the email that was flashing, and it was from my corporate legal officer at Nomura. And he said, have you seen what's happened? Lehman Brothers has filed for bankruptcy. I didn't know. And at that point, we realized that the Fed had not bailed out Lehman Brothers. We were shocked ourselves, completely shocked. Well, the first action I did at that point was call Tokyo, 6 in the morning, was already, afternoon in Tokyo. And I said, I am doing this, I'm not taking permission from you, but I am putting in an EOI, an expression of interest, into the administrator that is looking after Lehman Brothers to buy Lehman Brothers. So that was my first action. The second action was to think why this happened and what really happened in the Fed and try to figure it out. What they did was they bailed out Merrill Lynch. Why did they bail out Merrill Lynch? Because Merrill Lynch, instead of bailing out Lehman Brothers, because they only had a fixed amount of money to bail companies out, they bailed out Merrill Lynch because they thought Merrill Lynch had a much, much broader spread of retail banking and retail brokerage than Lehman Brothers had. Lehman Brothers was very much an institutional investor, and they thought, well, this is just an institutional investor. If Lehman Brothers goes down the tube, who cares? Because all these big boys are going to lose. If Merrill Lynch goes down the tube, we care because all the grandmothers and aunts and uncles who own stock in the stock market trade through Merrill Lynch, so we should be careful about them. So they bailed out Merrill Lynch. How did they bail them out? They forced Bank of America to buy Merrill Lynch. And they abandoned Lehman Brothers. Big mistake. Big mistake. Why? Well, this is technical, but it was because Lehman Brothers had a huge prime brokerage franchise. Prime brokerage is where stocks are borrowed and lent, and that affects the small guy a lot more than the retail operation sitting on the side. But the more important problem was this. Having saved Bear Stearns, everybody's heard of Bear Stearns, Bear Stearns went belly up just a few months before in America, another brokerage firm. All the bondholders of Bear Stearns got virtually all their money back. The subordinated debt holders got 50 to 75% of the money back. So the bondholders got bailed out and the stockholders lost all their money. Bear Stearns was bailed out, no question about it. Northern Rock in the United Kingdom was bailed out. Everybody's heard of Northern Rock. So the market was casually sitting around on that weekend of September 13th, 14th, 15th, fully expecting Lehman Brothers to get bailed out, and the key person on Sunday expecting Lehman Brothers to get bailed out was Dick Fuld, the CEO of Lehman Brothers, and it didn't happen. Dick Fuld was shocked, justifiably. But who was really shocked? The markets. Up until then, the markets had continued to trade through the crisis-ridden thoughts of 2007 and 2008. The bid-offer spreads in the market were a bit wider. Some products were a bit less liquid, some were a bit more liquid, but the market traded. You could trade everything, maybe at a slightly wider bid-offer spread, but you could trade. On the 15th of September, the markets went completely catatonic. They stopped trading for 4 days. For 4 days, the market stopped trading. Why did that happen? Why did that happen on that day? Let me try and explain. So you're playing chess. You're in the middle of your game. You've been told this is how the knight moves, this is how the king moves, this is how the queen moves. Somebody comes along and says, right in the middle of the game, the knight no longer has this crooked way of moving. From this point forward, instead of moving up to left one, right one, down to left one, right one, is going to move like a bishop does. Both of you are told this thing. What are you guys going to do? You've got a clock sitting next to you. Are you going to make a move? Highly unlikely, because you don't know what the consequences are. So you stop trading. You stop moving. Why? Because the rules of the game got changed. What were the rules of the game until September 15th? We will bail you out. Even if your bloody little Bear Stearns and your little Northern Rock will bail you out. But they didn't bail out Lehman Brothers. So the markets went completely dead. 4 days later, they announced TARP. Does everybody know what TARP is? TARP is a US bailout program. Do you know how much it was? $760 billion. Big number at that time. Why? Because markets died. Every institution that had huge positions suddenly faced bankruptcy. AIG, Goldman Sachs, anybody you care to think of, Morgan Stanley, most of these institutions were gone. They were history. So they had to come in and they had to say, sorry, didn't really mean that. Sorry about Lehman Brothers. Sorry about letting them go bankrupt. In reality, we didn't mean that. Apologies. And how are we going to say sorry to you? Here's $764 billion. We're going to buy all these shares and make sure that none of these other buggers with huge risk on their balance sheet is going to be blown out. Where's the endogeneity in this? The endogeneity is that the actions of the regulator cause the results in the market, not the other way around. The regulator isn't out there saving you. 9 times out of 10, the regulator is putting in rules and processes that encourage risk-taking and that then come in after the fact, barn door after the horse has bolted, to try and save things and justify them. Why do I know that the regulator knew what was going on well before? Let me explain. Why was I talking to the Fed the week before Lehman Brothers had died? I had been looking at Lehman Brothers for 4 months before that. For 4 months. Why? Because I knew what was going on at Lehman Brothers. From January of 2008 to September of 2008, in those 9 months, the leverage ratio of Lehman Brothers' balance sheet, I hope you're all sitting down, went from 18 to 1 to 32 to 1. That's what happened to the balance sheet of Lehman Brothers. Remember what I was saying. If you are a stockholder and you are the manager of a banking institution that expects to get bailed out, when the stock price drops and the enterprise value drops, your incentive, perfectly economically, rationally, no ethics, no morals, is to increase the risk on the balance sheet. And Dick Fuld did that in spades. And the institution of Lehman Brothers did that in spades. So as I said, I don't have a PhD thesis to prove this happens to you. I just have a lot of casual empirical evidence that this happens. And some of it is not so casual, because I ran institutions that did exactly this kind of stuff. So what people need to understand is that endogeneity, recursion, the fact that there is a feedback loop is something that regulators need to understand, be very aware of, and act on. And they did not act. They did not understand what was going on with Lehman Brothers in 2007. When I actually did the transaction to buy Lehman Brothers, one thing that we did not acquire as Nomura, but something that Barclays acquired in the United States, was the balance sheet of Lehman Brothers. I didn't touch the balance sheet. The balance sheet is still being wound down. What we acquired was all the people, the systems, the clients, the buildings, everything other than the balance sheet. Within a day, we went from 1,700 members of staff at Nomura to 5,700 in one day. Our expense base went up by billions, and we had to learn how to manage it. But it was the greatest trade we ever did in our life. It was an unbelievable trade. And who gave it to us as a gift? The regulators. So this whole story started from a little warrant trade with endogeneity built into it, went to stocks and ownership of equity with endogeneity built into them, and then you go to the regulator and you get the endogeneity built into the regulator's rules. It is absolutely crystal clear that this is what happens. The regulator in the United Kingdom was fully aware of this stuff. In fact, what gave me, again, I'm sorry to be personal, but it gives you an idea about where some of these learnings come from. What gave me the right to buy Lehman Brothers in 2008 was the fact that in 2007, Nomura had a balance sheet of $5.5 billion in subprime loans. How many people know what subprime loans are? Good. Subprime loans are loans that are given to house buyers that are not very good credits. And the collateral is the house. And Nomura had bought these, and they had $5.5 billion of it in 2007, and they were hoping to securitize them and sell them off. They were hoping to sell them off. Forget about securitization. They were hoping to sell them off at a profit. And I saw this was happening in 2007. I thought it was completely ridiculous. It would never work. I convinced the board of Nomura to sell the whole thing and take a $1 billion hit. Do you know what it's like convincing a board of a large financial services institution to do a trade, forget about accounting, forget about finance, to take $1 billion hit because the future is going to be more bleak than what it looks today? That was a tough exercise, and we did it. If you guys go and watch a movie called The Big Short, you could get it on the web, wherever. It's a book written by Lewis, what's his first name? Michael Lewis. It's a great book. The movie is even better. What they were doing in The Big Short is what we were doing. I was not the first person. Goldman Sachs was in front of me. And by getting rid of that and taking a $1 billion hit, we saved ourselves over $4.5 billion. And therefore we had the resources available in the big crisis of 2008, not to be scared, a deer in the headlights, but to step up and take advantage of something that was absolutely going wrong. So that is my little story about endogeneity. At the end of the day, I want to show you some slides, and I don't know whether they're in the order that you can go and read this at some point in the future. But every single financial crisis that ever happened in the market led to regulatory change. Every single one of them. Every single financial crisis that ever happened in the market can be very clearly seen to be rooted in debt, in the acquisition or creation of more debt to own assets. And the reason that happens is again because of what I've been talking about, which is a debt holder is always the guy who pays in the last. Almost the last, the shareholder is the one who pays at the end. By and large, debt holders have now become smart enough to understand that this moral hazard exists and therefore price their debt accordingly. But at the end of the day, when the moral hazard actually happens, they can't price it. It's too late by then. And the regulators, without any question whatsoever, have not understood that. The most recent example of that, forget about 2008, was 1998. I spoke about this company called Long-Term Capital. They failed in 1998, post the Thai baht crisis. And the Thai baht crisis, they had a huge position and they collapsed. And the Fed came in and bailed them out. Why did the Fed bail them out? Because they said this would have a systemic impact on the financial system, because all of the contracts that LTCM had written were with the US banking system as well as the European banking system. So they bailed them out. Markets have long memories, and they believed that this bailout process, if it could extend beyond banks, even to a hedge fund, is going to be something that extends to other financial institutions as well. And so that was fresh in people's mind in 2008. And my final comment to you is that regulation actually does encourage risk. Regulation does not attenuate risk. It encourages it. And the way it does it is essentially by having the following contract with the market. Come into this little tent. We will give you a little bit of oligopolistic power because we are going to regulate you such that you have to put in a huge amount of capital to be able to do the business that we expect you to do, i.e. banks. We expect you to do this business. We want you to put up a lot of capital. Not very many of you can put up the capital, so we're going to have a very small oligopolistic group of you. And we're going to regulate you. And what we're going to do is, in return for regulating you, we're going to bail you out. In 1929, 1930s, FDIC was set up. Do you know what FDIC is? The Federal Deposit Insurance Corporation. It was a federally funded insurance company. If I deposited less than $100,000 in a bank, I was assured that that was government risk. So if I wanted to deposit $500,000, I deposited it in 5 different banks, and my money was completely safe, completely government credit risk, but I was getting a market return on it. What am I going to do? I'm not going to be a hero and say, look, I'm not going to do this. I'm taking advantage of the Fed. I'm going to do that. And people did that. And so when the original savings and loan crisis happened, all of these people had to be bailed out. And why was all this risk being taken? Because everybody knew that this insurance existed. When insurance exists, you always take a bit more risk. Take, for example, your car. If your car is uninsured, completely uninsured, you're going to drive it pretty carefully. You're not going to want to hit anybody. Because if you do, you're toast. So the car has to be insured. Once it's insured, you're going to be just a little bit less careful about risk. Because you know, पैसे दे देगा कोई ना कोई. Insurance company दे देगी. हाँ, तुम्हारा premium ऊपर चला जाएगा next year, but the insurance company is going to pay for it. And that's called moral hazard. And in space that exists in the financial services system. I want to show you one final slide, if I can find it, which is not so much about moral hazard. Oh, by the way, I want to show you this slide. Let me talk about this slide, then I'll go to the final slide, and then I'll stop. Because the last slide is something that reflects on Pakistan. But I'll come to that later. This is a very interesting slide, and I want you to understand how markets can get it wrong. Because they believe in the regulators. Can you see it well enough? Can you read the dates underneath? Okay? Those lines are the yields on government bonds in the European Union. Notice what they look like all the way till, other than a little blip in March 2009, September 2009. In fact, January 2010, I can tell you with authority because I was there. Germany is a kind of purpley line that is very steady and declines over time on the bottom. Notice that every European government yield credit risk was trading at or about German risk. Knowing what you know today about Italy, Greece, Ireland, Spain, do you think that's rational? Absolutely not rational. Why did people believe that? Markets are rational. Why did they trade like that? They traded like that because they were stupid enough to think that no country's debt would ever be allowed to fail. What they forgot was that within the European mechanism, there was no taxing mechanism to allow the money to exist to bail a country out. When did that realization hit? In January 2010. Which country did it hit with first? Greece. So no prizes for guessing that the green line is Greece. No prizes for guessing that the light blue line is Spain, Ireland. The darker blue line is Spain. And then Italy is the one that is bouncing around here, the orange one. Suddenly people realized in 2010 that the regulator was not, or there was no regulator and there was no system available to allow them to play the moral hazard game that they had been playing for so long. And that is why when the crisis hit, the ECB had to jump in and say that we will repo even the securities of Ireland and Spain in order to give it comfort. They had to bail the system out because there was no other taxing mechanism. The ECB had to step in. Again, stupidity of regulators. Now let me go to the final slide, and I'm not going to bore you very much more. This is what happens to currencies when currencies are kept because the governments and regulators and other people want them to be kept stable or strong, quote unquote. Whenever any country says to you, we want our currency to be strong, sell it short. There's just no question about it. No question about it. History is absolutely littered with examples of this. What I don't have here is the United Kingdom. George Soros. Every country that tries to maintain its currency at an inappropriate level will find that the market will fight it. And the market won't fight it in the beginning, but as the pressures build up, the market will fight it. So this is about the Pakistani rupee. Somebody said to me, you've got to make one prediction, Sadeq Saab. आपने एक prediction नहीं करनी अपने ये presentation में सारी analytics कर रहे हैं. Make one prediction. I still won't make a prediction. I just want you to look at this chart and tell me, as of zero date is when the crisis happens, just take a look at the volatility of the underlying currencies after the bubble bursts. Just take a look. It is not pretty. Thank you very much.
Questions?
Any number of questions. Yeah.
Sir, we have 300 live viewers on social networks and IBA website.
Sorry?
300 plus live viewers on social networks. But there is a question from a live viewer.
Okay, I'm glad you told me you have 300.
So what can regulators do knowing that behavior in financial institutions is often determined by the incentives you were talking about?
All right. So the question is, what can financial regulators do if they know that we have these incentives built in? I.e., I'm getting all these stocks and call options from my bank, and the regulator knows I'm getting those. What can they do to fix it? Let me give you the answer in a two-pronged way. The first answer has to do with what they actually did in 2009 after the Lehman Brothers crisis. And then the answer I will give you is what they should do. What they did in 2009 was they dragged me, as CEO of Nomura, into a room at the FSA and the Bank of England, and they said, sir, you do know that you have to subscribe to the G20 rules on compensation in your institution. I said, yes, I do. Can you please re-articulate to me what those G20 rules are? You know what they said to me? And this is Lord Turner and Hector Sands, Abnamlikle. Here's what they said to me. Mr. Sayeed, you have to make sure that 40% of the compensation that you give to your top management is in stocks and options of Nomura. Stocks and options on Nomura. And I said, sir, what do you think the Lehman Brothers staff were getting paid when they went bankrupt? Sir, 80% of the compensation of the top guys in Lehman Brothers, of which there were 80 or 90 of them, was in stocks and shares of Lehman Brothers. What kind of incentives did that provide for Lehman Brothers? Well, you know the answer. 2 years later, 2011, I had just come off the board of Nomura and I had retired as CEO. I was called in by the Bank of England and I was told, look, you had made this comment, because memories bahut lambi hoti hain. You had made this comment in 2009, fine, there was a critique of the G20, what is your solution? What is your solution? Paul Tucker, I don't know if you've heard the name, was the person who put me on a carpet and said, you know, ye sab criticize karna chhod dein, positive solution bataiye. So Manaka, it's a very, very simple solution, and I'll tell you this today, there are no patents on this, wish there were, but there are no patents on this. The solution is very simple. How do you reduce moral hazard in these things? The way you do it is to ensure that the incentive structure is aligned with the underlying security holder when it needs to be aligned with that security holder. Example. If I only own shares, I will only look after value for the shareholder. So when the enterprise value is equal to the value of debt, I will take a risk. Correct? We've understood that. Because if it goes down, the debt holder pays. If it goes up, the shareholder pays. Gets the benefit. So what they should give me as one of the top management of an institution like a financial institution is not just shares in compensation, but the entire capital structure of the firm. So every year, I should get 80% of my compensation not in cash, but in shares that vest, and the shares are 20% of the enterprise value of the company, I should get 20% shares. If senior debt is 50% of the enterprise value of the company, I should get 50% senior debt. And if the remaining 30% is subordinated debt, I should get subordinated debt. That should be my compensation structure. Ab aap sochein. Stock price goes to zero, main kya karunga? Am I going to take a lot of risk? Probably not, because I've got debt. I've got subordinated debt. That's the first one that gets hit. If my subordinated debt goes down, am I going to take a lot of risk to bring it back into the money? Probably not, because I've got 50 cents of every dollar that I have of senior debt. Simple, absolutely trivial solution. Regulator can benefit the markets by coming up with solutions that are in keeping with human nature and with the capital market system. Instead, here's what the regulator does. The regulator says, I've got to regulate you because I bail you out, so I'm going to come in every week and I'm going to look at your accounts. I'm going to look at the risk you take. I'm going to worry about this, worry about that. And I say to the regulator, and I asked these people, please do come in and look. What's the point of looking at my accounts? My accounts are a snapshot. It's not a movie. Markets are dynamic. You need a movie. My accounts are a snapshot. And they're a snapshot from some time ago. At that time, there was a movie called Avatar. How many people have watched that movie or seen it? It was a very famous 3D movie, and it was unusual for the time. And I said to him, to Turner and Sands, that looking at accounts and regulating me on the basis of my accounts is like trying to understand Avatar with 6 snapshots. 6 snapshots. Can you get to know what Avatar is like? No. So I said to him, the right way to do it is this compensation structure to Mr. Tucker, and then send in people to my executive committee on a random basis every so often to see the decisions we make. That is proper regulation, not rule ticking and box ticking exercises. So that's a simple solution to the endogeneity problem that is caused by stock grants. G.
Options and derivatives, which normally are supposed to work as hedge in the portfolio, can they be blamed for the, this financial crisis?
Very good question. If we didn't have, the question is this, if we didn't have options and swaps and futures markets, would our financial system be more stable? What do you guys think the answer to that is? You think so? Huh? I like that. Yes, it would be boring. But you know what? The capitalist system already has derivatives built into it in an incredibly large way. And the biggest derivative built into the capitalist system is your stock, is equity. So you already have that derivative built in. And the efficiency of having what we call in our business contingent claims, that's an option, a claim that is contingent upon an event happening, is basic to the fundamental system. To have a swap, or to have an option, or to have other types of derivatives like CDSs and things of that nature, do not either increase or reduce risk in the system except through their impact on endogenous behavior. They do not increase or reduce the risk because they are contractuals. They do not benefit from growth in the economy. They are between party A and party B. All they do is they transfer risk. Now, if those derivatives and contractuals transfer risk systematically to those who have an incentive to increase volatility, of course, they can cause a problem in the financial system. Example was Dick Fuld. Example is the systemic granting of stocks and stock options to the banking system, to the commercial and investment banking system, together with what I call the put option, the bailout option, by granting this systematically to individuals or to companies who have the endogenous behavior reflected in what I have described. Yes, that can cause more risk in the system. There's no question about it. It isn't the contract that is to blame. It is the actor. So like they say in America, very stupidly I have to add, it ain't the guy who kills the guy, it's the gun that kills the guy. Right? So don't blame the gun. Unfortunately, you can't blame the gun, because if the gun didn't exist, you wouldn't kill him. And because the gun exists, it's endogenous behavior. You've got the gun, you're going to kill somebody. So there is definitely that. What a regulator needs to do is to allow the benefits of these contractuals to distribute risk to where they are best, where risk is best held, and then regulate and control that intelligently, not stupidly, and not cause more risk by his or her own behavior. So I hope that came somewhere towards answering your question. Just blaming the gun is not enough. You have to blame the incentive structure. Yes, miss.
How would you change the incentive structure within the regulated financial institutions as per the markets you have highlighted?
Almost looks like I planted these questions. That's an excellent question. How would you change that? You know, the first thing is to have slightly smarter people in the regulation world. By and large, the regulators are not the best. Let me try and explain what I mean by that. So I'll give you a story again casual empiricism, but I'll give you the story. So part of this conversation I had with the FSA in terms of compensation in 2009, it was followed up by a conversation at the end of 2009, beginning of 2010 with the regulator again, about hiring and firing policies in the institutional world. And at that point, we had taken the staffing at Nomura from 5,700 or something back down to about 2,400. So we fired a lot of people. And the world is not a safe place for this kind of stuff. So I went in, and the regulator wanted me to talk to him about, again, how to change the regulatory world. And I asked him, sir, the City of London has gone from 350,000 people at the beginning of 2008, middle of 2008, to something like 310, 315,000 people now. So taqriban 35 to 40,000, a little over 10% of the staff in the City of London had been fired. So I turned around and asked him, how many people have you lost? It was actually a question with inquisitiveness built into it, not sarcasm, because I didn't know the answer. And the answer came back, oh, I'm happy to tell you that we've only lost one person. I said, so you don't think you have anything to do with the state of the financial system today, that you had no role to play? There's nobody within your group that ought to have had the responsibility, to some extent, of getting in front of this crisis? No, Mr. Sayeed, this crisis is caused by people like you, not by people like us, was the answer. And he said to me one even more terrifying comment. And the terrifying comment was, we need more regulation, not less. So I said, where are you going to get the people to regulate us even more? He said, well, you just told me that you've let 35 to 40,000 people go from the City of London. So I said, Mr. Turner, can I ask you, do you think, whatever you may think of us, that we've let our best people go? Who do you think we fired? When we need to get rid of costs, who are we going to get rid of? And these are the people that you're going to hire from to regulate us? I'm sorry, sir, it doesn't work like that. So, unfortunately, I'm a blunt SOB, but there is no point in not being that way. And I think it struck home. So the first thing that has to happen is that regulators need to be smart. They need to be paid properly. And the third thing that is most important is they need to be able to look at the incentives of people and the incentives created within compensation structures in institutions to determine what happens in the future. Nobody behaves in a static way. The regulator thinks that the world is composed of one-step games. He doesn't see the world as being composed of multi-step, multiplayer games. He sees it as a one-step game, and his game is, I'm going to tell you this is the way you're going to behave, and then he goes off and sleeps very happily in his bed, believing that everybody will simply follow his advice or his rule, because if they don't follow his rule, he's going to jail them or do something like that. Guess what? The people don't do that. They come up with mechanisms to go around it. So the regulator needs to understand that it's a rational expectations world. When you tell me you've got to behave this way, I will react. He's got to be able to react to that reaction, and then a couple steps more. And that requires intelligence. That requires communication. That requires partnership. That requires information. And I'm afraid to say that the regulatory world today has not learned anything from 2008. So the next question somebody is going to ask me is, so if 2008 was a big crisis, what's the next one, and where and when is it going to happen? Well, I don't know when you're going to ask me that.
But what do you say about cryptocurrencies?
About the what?
Cryptocurrencies.
Oh, cryptocurrencies.
For what we don't have any regulator.
Very good point. But listen, that's a completely new world. I don't think we all understand Bitcoin and all of that very well yet. And we at Silk Bank are actually trying to figure it out. But cryptocurrencies are not going anywhere. They're going to get bigger and bigger and bigger and better and better and better. There is no question about that. But let's leave that, because it doesn't have the kind of stuff that I like to talk about. We can talk about that privately or later. And I just wanted to talk about the regulators, and the regulators just need to be a bit smarter and a bit more engaged. Ji.
I have a question regarding the credit rating agencies, because one of the players in the market was credit rating agencies, which actually rated the CDOs as AAA and all those things, which actually made people think that everything is going to be profitable. So this is my first question. Second question which I would like to ask is...
Ek bit, I'm not smart enough to figure two out. Let me answer that, and then I'll come to you for the next question, but I'll come to you first. Credit rating agencies are clearly one of the group of actors that gave rise to the bubble that became the financial crisis. And unfortunately, the way our systems work and the way our rules work, that is going to happen over and over and over again. There is no getting around it. Okay? So 1929 was a crisis. There were many crises before that. You just have to look at my presentation. 2000 was a crisis. 1987 was a crisis. 2008 was a crisis. Our capitalist system, which has all the other benefits, has this flaw. One of the problems with the system is that it cannot punish well and efficiently. It just cannot. Today, the rating agencies that played havoc with the system in 2003, 4, 5, 6, 7, and 8 are still the same rating agencies. None of them has closed down. They are still the same people to whom everybody looks for information. I think that's a bunch of mumbo jumbo. It is absolutely terrible. I do not have an answer or an explanation for that other than the following, that the institutional investor world, of which I'm not a part, I was an investment banker, but the institutional investor world, which gives credibility to these rating agencies, that needs to change. And that institutional investor world is completely conflicted. It is the worst environment I have ever seen in the world. We investment bankers are told we get paid too much. Well, the institutional investor world gets paid way, way too much, because by and large, they perform almost beta 1. They almost never outperform the market, and yet they collect fees ranging anywhere from 100 to 200 basis points. It is highway robbery, and people get away with it. And there's a circularity argument in this, which we can talk about later, but it is because the institutional investors need to point a finger at a consultant or a rating agency to get rid of risk from their own, legal risk from their own institution, that these kinds of institutions are encouraged to thrive and survive. But you're absolutely right, the rating agencies do not pay enough attention. Having said that, the logic of having AAA, AA, and other securities was absolutely fine. And the mathematics behind it was absolutely fine. What was wrong with it was to allow institutions to mark those assets on their balance sheet to a model. That's called level 3 pricing. And level 3 pricing came in the United States before the Lehman Brothers crisis. And level 3 pricing is invented by the accountants to make it easy for themselves. So they allowed a model to value the securities. And that model did not take into account serious, what we call tail risk. If you took the distribution function of the underlying variables and you widened it and thickened the tails quite a lot, you would come up with answers that said that AAA security was nowhere near AAA. I'm not talking ex post, I'm talking ex ante. Sorry, I'll come back to you later. Ye pehle the, aap bolo. Microphone piche. How do I see Pakistan?
Yes, how do you see us as a
You know, I don't know, the thought police might be out there. But honestly, I don't see much of a future for the financial markets if they allow this kind of stuff to perpetuate in Pakistan. It is reprehensible. People have tried, my dear friend Salu has tried to broaden, deepen, but it hasn't happened. And the story of why, I'll let him answer at some point, but it's a long story. It has to do with a bunch of things other than just the financial markets, in my opinion. It has to do with cabals and groups. It has to do with our political system. It has to do with education. It has to do with a bunch of things. Other markets are much more developed. Thailand is considerably more developed. Even Malaysia is considerably more developed. And we are very far behind. Yeah, we're nominally the best performing market. You're absolutely right. You know, we'll see what happens, but we're nominally the best performing market. I don't want to comment on what I think at the end of the day is really a political problem, not a financial problem. It's a problem of having proper regulators and people who care about the country to push through reform. And we don't have in this country that jazba for people to get in there and push through reform for the benefit of the country rather than perhaps the benefit of themselves. It's a very small group of brokers. It helps them have a very small market, a very small set of stocks. They can trade it, they can manipulate it, it's much easier. Family offices don't like to issue new securities, don't like to issue, I mean there is, you know, this is a litany, this is not a simple answer. And it's not going to get solved like that. But what it does need is political will and the right people to be put into the right positions to change law, to change practices, and to bring in the proper system. Because without that, Pakistan ain't going anywhere. That's for sure. One more. Kisne pooch?
सादिक साहब बहुत शुक्रिया आपका. मेरा नाम एजाज है. आई वर्क फॉर आरिफ हबीब ग्रुप और मैं IBA की विजिटिंग फैकल्टी मेंबर भी हूँ. टीचिंग हेयर फॉर द पास्ट 20 years और सो. 3 इश्यूज़ मुझे फाइनेंशियल मार्केट में ऐसे बड़े लगते हैं. वन इज़ पार्टिसिपेशन, यानी कि बहुत ही नैरो बेस है. सेकेंड, फाइनेंशियल मार्केट में डेरिवेटिव्स नहीं हैं तो कोई इनोवेशन भी नहीं हो रही है और ग्रोथ भी नहीं हो रही है. और तीसरा, हाउसिंग फाइनेंस नहीं है मुल्क में. एक अगर मैं आपसे ये रिक्वेस्ट करूं, मतलब ये 3 लोग अभी जो बैठे हैं, सलीम रज़ा साहब हैं, डॉक्टर फारूक हैं, अभी मुझे लगता है कि आप तीनों के पास थोड़ा टाइम है 5, 8, 10 साल खेलने का. अगर हम प्रायोरिटाइज़ कर लें इन 3 में से कोई एक चीज़, जो मुझे लगता है कि हाउसिंग फाइनेंस पहली प्रायोरिटी होनी चाहिए और डेरिवेटिव्स और पार्टिसिपेशन में हम प्रायोरिटाइज़ कर लें, तो कोई ऐसी हम स्कीम बना सकें. बिकॉज ये जो एक्सपीरियंस से आप गुजर के आए हैं, मैंने ये 2008 और 98 का क्राइसिस बुक्स में पढ़ा है और मैं अक्सर सोचता था
इतने यंग हैं आप, दाढ़ी से तो नहीं लगते.
ये मार्केट में रहने से ऐसा हो गया है. अच्छा. तो मैं अक्सर सोचता था मैं लोगों से मिलूंगा कि जो इस क्राइसिस से गुजर के आए हैं. बिकॉज मैं 2008 के लोकल क्राइसिस में बहुत सेंटर में था तो बहुत एंजॉय किया, बिकॉज सर्वाइव कर गए और आप माशाल्लाह सर्वाइव करके आए हैं. तो आपसे हम कभी अलग से सुनेंगे एक्चुअल डिटेल्स. तो अगर इन 3 प्रॉब्लम्स में से पार्टिसिपेशन, डेरिवेटिव्स और हाउसिंग फाइनेंस, 3 में से को अगर हम प्रायोरिटाइज कर लें और IBA के प्लेटफॉर्म को और आप लोगों की एक्सपर्टीज़ को यूज़ करके कोई टेंजिबल कंट्रीब्यूट कर सकें. बिकॉज इफेक्टिवली जैसा आपने बोला 25 साल से मार्केट ऑलमोस्ट डेड पड़ी हुई है. तो इस पर मैं आपका कमेंट.
I'll give you a quick comment and you can talk to Farooq and Salim about it as well later if you like. But I want you to go back in history a little bit. The burgeoning of the derivatives market and the efficiency of this market occurred in the United States when the mortgage-backed securities market was created. All CDOs, CLOs are entirely and completely identical, but much simpler than a mortgage bond. Much simpler, because a mortgage bond has all sorts of prepayment risks. It was much more complicated, and there was optionality derivatives built into every single aspect of it. It was a very complicated structure. But that gave rise to the deep liquidity and the deep understanding of contingent claims that we see in the capital markets today. Before the mortgage market was created, the futures market, the swaps market, the bond markets were pretty dull, dead and boring. उनमें जो excitement थी वो नहीं थी. So आपका जो कहना है कि mortgage finance or housing finance could be the trigger, is that I believe in it in a really serious way. Because, not because there's something special about houses, but because property ownership is extraordinarily wide in Pakistan, both institutionally and individually. That's point number one. Exposure to the property market is something that is desired by a lot of people, but is unattainable because they are not wealthy enough to have it. They need to be able to own exposure to the property market in smaller chunks. And consequently, what you need is a property portfolio that is able to be broken up into smaller and smaller bits, listed on the stock exchange or some such thing, so that it has some transparency, regulated properly so that the rules underlying finance and what happens in crises are well set. And then there has to be a distribution mechanism that allows this thing to work. And then on top of that, you can build the optionality that we expect. I think that's a very, very good idea because of the size. Not because, you know, there are only so many cars, so auto finance is not a big deal. There are only so many credit cards, so credit card finance is not a big deal. Scale matters. And the one asset in this country, or any country for that matter, the problem that we've had in Pakistan is the right to a piece of property under bankruptcy is not perfected in law. Now, Shaukat Tareen, my friend and partner in Silk Bank, while he was finance minister and subsequently, has made great strides in trying to ensure that that perfection of right, you cannot do this without law, without good law, where you know under what circumstances what transpires. That perfection of right is coming in Pakistan, and therefore it is giving us the ability now to create portfolios of property and do, you know, derivatives and financing of those pieces of property. We are very, very far away. It's a bit chicken and the egg. और अगर हमारे पास वो तमन्ना नहीं है कि फाइनेंशियल मार्केट्स को ग्रो करें, तो आप उसके अंदर एक वो भी घुसा दें, उससे नहीं चलेगा. ऊपर से इसका वो आना पड़ेगा. There has to be some, and I would imagine that if serious and senior financial services individuals in this country want to start kickstart the financial system into the modern age, the housing market of the three choices that you have given is probably the best leverageable. That's what my belief is. Farooq may believe differently, Salim may believe differently, but that's my belief. Okay, how many more? One more? I guess everybody's pretty much... Ek aur, huh? I'll give one more.
Assalamualaikum boss, I am Kamran Khatri.
Sorry?
Kamran Khatri is a banker in a 10-year exposure in a capital market, is a banker financing. But जो मैंने देखा स्टॉक मार्केट के अंदर 10 years के एक्सपोजर के अंदर बैंकर्स जो है वो बहुत ज़्यादा रिजिड होते हैं टू प्रोवाइड लिक्विडिटी और हेज फाइनेंस टू द इंडिविजुअल्स. दे मोस्टली प्रोवाइड टू द फाइनेंस टू द ब्रोकर्स. तो ब्रोकर्स उसकी क्लाइंट सेग्रीगेशंस एंड अदर इश्यूज, देयरफॉर नेशनल क्लियरिंग हैज़ बैंड कंप्लीटली दैट यू आर नॉट अलाउड टू फाइनेंस द इंडिविजुअल बिकॉज ऑफ सेग्रीगेशंस. सो इस तरह की जो बैंडेज लास्ट ईयर से मेरे ख्याल से इम्प्लीमेंटेशन हुई, जिसकी वजह से मार्केट में वॉल्यूम्स भी बहुत ज़्यादा स्लो हो गया है. और जो नॉर्मली दूसरे कंट्रीज़ के अंदर अगर हम देखें तो इट इज़ क्वाइटली अलाउड. इवन बैंक कैन अकोमोडेट देम, और बैंक कैन प्रोवाइड अ प्लेटफॉर्म टू बाय द शेयर्स एंड सेल द शेयर विद देयर ओन प्लेटफॉर्म सो दैट दे कैन हेज देयर फंड विद द proportion ratio. Maybe the banks provide a rate of 8% and the return they are getting from the equity maybe 20% or 30%. So they are doing though. But we don't have some market in a capital market where the individual investor can invest and they can build a financial market and build their own money. So it is a lack of the financial market for respect to individual point of view.
Okay, I'll take that as a comment. I don't think that is right, but I'll take that as a comment. Okay, thank you very, very much for bearing up with me. Most appreciated. Thank you.
so much, Mr. Sayeed. It was indeed a pleasure hearing whatever that you had to say. And although I'm a non-financial person, I enjoyed every second of the lecture. And I'm very grateful to the students who were here, who took keen interest, asked interesting questions. Thank you to all the guests who took out time to be here. But more importantly, मैं उन तमाम लोगों का बहुत शुक्रिया अदा करना चाहती हूँ जिन्होंने Facebook पर हमें लाइव इस सेशन को देखे हैं for the last 1 hour now. 300 से ज़्यादा लोग इस सेशन को लाइव देख रहे थे और सवाल भी भेज रहे थे. So thank you to all of them. And now if I may request Dr. Farouk to come and formally thank Saeed Saab and offer him the small token of appreciation that we have. No, आप कह दीजिए बस बुला लीजिए.
Great, okay.
Saeed Saab, would you?
Where's the token? All right. Yes, good, okay. Thank you all for coming, and thank you, Sadeq. This is, we're meeting after a while, but we're meeting in a situation where, you know, you sort of, you get to show everyone what you've been doing for the last 40 years. I'm very happy that I've had a chance as Dean of IBA to have you visit here and to give a seminar. This is one of the topics, financial economics, I guess, where we hope that IBA has some reputation. And I hope with seminars like yourselves and guest speakers like yourself will continue to sort of keep a reputation alive. Okay, thank you. Yes.
Just Executive Education and Dr. Izhar for hosting this. So thank you, Izhar sir. Okay. Thank you, Saeed Saab. Thank you, Dr. Farouk.
Refreshments are in the foyer area. Thank you very much.